my bias would be we're headed into a recession. There's likely to be an earnings contraction in corporate America, and that is likely going to be happening in commercial real estate as well. So be careful of the asset class that you're in, but there's also good reason to be optimistic because as sponsors find assets that benefit from transition in the economy, those assets that throw off cash durably and consistently, the multiple, the cap rate is going to, from my perspective, get compressed even lower because the valuations are going to go higher because the cash flow is coming off more and more and more. And so if you find pockets of commercial real estate where tenancy moves higher as the economy transitions, then you're on to something.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. With Real Estate Breakthrough, and I have Ted Greene with me from Spartan Investments, and I'm excited to have Ted with me. Ted and I were talking at the Best Ever Conference, and he told me about his background in equities and that he has transitioned over to real estate. And I went, you know what? We really need to have a conversation. I have a list of questions for him today. But really, first, let's start with, well, what does it mean to go from an equities guy to being a real estate guy? So tell us a little bit about your background so people can understand why I'm excited to hear your point of view on what it means to invest in real estate versus equities, why you prefer it. Then we'll get into the S&P failures as well, the SPV failure. And so let's just talk to me about your equities background first.
Well, Christina, thank you for having me, by the way. My name, again, is Ted Greene, and I'm with Spartan Investment Group on the investor relations team. And this is a real privilege for me to represent Spartan to you and your constituents. By way of my background, out of college, I started at Merrill Lynch and spent 24 years in that industry, finishing as a portfolio manager and chief compliance officer at a registered investment advisor. So personal responsibility for doing always what's in the best interest of the investor. And if I could, in 2 or 3 sentences, summarize that whole life's chapter of life, from my perspective, and by the way, Merrill Lynch, from my perspective, is a world-class firm. That said, the probability of success for the investor experience, because of the preferred return characteristic of an equity investment, the probability of success is just higher. It's just higher. They're not building more land. And so you can start and stop with the probability of success. And so while real estate could be considered an alternative investment, you might also think of it as it may be the more predictable investment as well. So anyway, I may have gone too long with that. I may need more detail on that, but so there's a first blush.
Well, I'm hoping we do get into more detail on that because that's actually exactly one of my questions for you. But because you also have this strong economic background, and as my listeners know, I hit the Great Recession. I've had 2 pretty large failures in my investment career. One failure was in the dot-com bust, which you and I both know, and I think love might be the wrong word, but having
it is.
for. Right? One was the dot-com bust. I had a pretty good loss there. And then the second one was in the quote unquote Great Recession, which is the 2008, 9, 10, right, downturn in real estate. And so those 2 downturns have taught me very distinctly that it doesn't matter how smart I am. And it doesn't matter how pretty I think I am, or how good looking I think I am, or how well connected or networked I am. The fact is, all ships rise and fall on the tide, and the economy, U.S. economy and the international economy in particular, is that tide. And that has to be honored and has to be paid attention to. And we're in the middle of another, what I call breath. The economy breathes in and it breathes out. You don't get upset when you breathe out. You don't get upset when you breathe in, but we get very upset when the economy breathes out, We get very happy when the economy is breathing in. So let's talk about this breathing out that is going on right now. So we just saw 3 bank failures, or 3 banks be bailed out by the FDC. In particular, there was the SBV Bank that was the one that was the headliner because it was the largest. So let's talk a little bit about how that is even possible for a large bank like that to be all of a sudden at risk. Let's break that down for a minute.
Yeah. So there's a couple of things there. Number one, it's eerily similar, remarkably similar to Orange County, California. Robert Citron, who was the then treasurer of Orange County, California, back in 1994.
Okay.
Prior to 1994 and Orange County filing for bankruptcy, as crazy as it sounds, it happened. And the reason for that is Citron was borrowing funds to buy bonds over and above the capital that he had invested in bonds already.
Okay.
So let's unwind that and talk about what that really means. It's kind of like margin. So you might have an investment portfolio for $100,000 and be just dead convinced that your favorite stock is going to go higher, and so you can borrow $10,000 or $15,000 on margin and buy more stock, and it works until it doesn't. And so we've heard this mysterious term as of late, and that is the yield curve is inverted. Well, okay, let's quickly dissect that. The yield curve inversion means that a 1-year CD pays more than a 5-year CD or a 10-year CD.
Yeah.
And that happens when the Fed raises short-term interest rates, and in the federal funds rate, it's actually the overnight interest rate that banks charge each other. It affects the prime rate, it affects the 3-month treasury bond yield, et cetera, et cetera. So anyway, if this is short and this is long, when the yield curve inverts, your short-term investments have a higher return than your long-term investments. And so if you've borrowed funds to buy long-term bonds the way Robert Citron did, the way Silicon Valley Bank Treasury had done, you get pinched where your long-term investments are going down because interest rates are going up, but then your borrowing costs have gone up significantly. So that's what got Silicon Valley Bank. That's what's rippling through the regional banking system, which last weekend I read an article. Goldman Sachs says that for small and intermediate term loans, the regional banks are doing 90% of those loans, which means the small and mid-size regional banks have a lot of loans on their books. And oh, by the way, think about this. What has happened to the office sector?
Okay.
So office, yeah.
I have that later
Yeah,
in the
so
session, so
office.
let's do it now.
Okay, yeah. So well, clearly this is not scripted then. So
I have
office.
my list of questions that I want to pull from you, knowing your background, but we can totally jump around. No, there's no script to
Sure.
it. I just
Yeah,
have certain
exactly. Yeah.
topics.
So office tenancy is down. Borrowing costs are up, and these loans have populated the books, or an IOU to a bank is an asset to a bank. Well, if the IOU, or if the borrower, if I've borrowed, $10 million from you, Christina, and suddenly, as a business, because my employees are not in the office and because business is down, it's a recession, I think soon to be recession for our local economy, and borrowing costs are up. I can't refinance I can't refinance my $10 million loans that I've borrowed. So you're the bank now. This asset that you have, which is my encumbrance to you, suddenly it's a troubled encumbrance, or the credit quality of my company has gone down because I can't refinance. So, so we've got a couple of things happening in the banking sector, which is some banks have just colored outside the line by way of risk, and have done what Robert Citron in Orange County, California did. In addition to that, COVID caused low office tenancy, and inflation, or a seemingly uh, transitory inflation, has temporarily caused inflation to be the topic du jour, which I think over the next 18 months, that whole topic is likely to fade. Be that as it may, we now have borrowers that are challenged regional banks that have trouble, as well as an inverted yield curve. And there is nothing new under the sun. It's never different this time. It's always the breathing in and the breathing out. And we've been breathing in since 2008.
Mm-hmm.
That's when the Fed lowered the short-term interest rates basically to zero, and we experienced that period of time for 13 years, and it lasted so long. Investors began to think, I am so smart. I've used risk to my advantage. I'm levered up. I am so smart. Look at my balance sheet. Well, it may have been a little bit more luck than smartness. And now, as there's a risk reset that always happens, it always happens. Now we're going to see who's got the durability to last through the next chapter where the Fed resets things by way of the federal funds rate. The economy slows. We have a recession, likely, I think, and we'll see who's swimming with the bathing suit on or off.
I agree. I mean, one of the two topics that you just touched on lightly that I want to highlight is it takes time for the effect of the increase of the federal funds rate. It always does, right? And generally, my rule of thumb is from 18 months from the beginning of the increases is when you start to really see the fallout. And it's hard to explain. I guess it's not hard to explain to you because this is going to make sense. But basically, it feels like they start increasing rates here. You've got 18 months for that increase to roll through the economy. Now they continue to increase rates. So it's not like, oh, here's this increase. 18 months later, we see the bottom. No, 18 months later, we start to see the effects. We don't know yet how deep the bottom is because there's this space between here and the 18 months when we're seeing the effects. What the Fed does in those 18 months is as important in being able to understand what's going to happen as far as the depth and the severity and even the length of this recession. So,
Uh,
go ahead.
yeah, that's exactly right. And the once you have the full effect felt of the Fed rate increases, and by the way, this week we have a Federal Reserve meeting, and the options market says we're likely to have a 25 basis point increase, and that's probably going to be it. But what that means is that 18 months from now, we will have felt the full effect of if there is a quarter basis point increase, taking us to 5.25%. So now, if we talk about what happens beyond that, going back to the 1950s, and we have had 11 recessions since the 1950s.
Yes.
The average activity by way of the federal funds rate is it's one or the other. It is either the federal funds rate, which is the tool that the Fed wrenches on to slow inflation or transitory inflation, from my perspective.
Mm-hmm. Mm-hmm.
The Fed either takes the federal funds rate back down below where it was when they started hiking rates,
Right.
or
Mm-hmm.
the federal funds rate drops by 5%. Now, we were at a quarter of 1% when the Fed started, and we're now at 5. So if we have an average environment, the federal funds rate is likely to go back, below 1%. So if you're a multifamily investor and your sponsor has an adjustable rate loan and that adjustable rate loan is starting to pinch, look forward. What has happened in the past on average is we typically will have a recession, then the Fed moves the federal funds rate back down lower, and we won't go into this today unless you ask, but then what? The Fed is what saved the economy.
Mm-hmm.
Beginning in 2008 and 9 by doing quantitative easing everything, and now we have a $31.4 trillion federal deficit and a debt ceiling,
Yeah.
and we're using federal employee tax dollars that they're deferring into their retirement accounts. Treasury is diverting those to pay the bills of the government. That's an example of an
Yeah.
extraordinary. I mean, this
Yeah.
is a scary time. So
Yeah.
anyway, I get myself all worked up, Christina. Sorry.
Well, you just brought up a really good one.
Yeah.
So I'm going to shelve my question for a minute, and then let's go into, in your opinion, what is the risk of the government doing something very similar to what the Silicon Valley Bank was doing, which is effectively taking reserves that have been allocated for a purpose, taking those reserves, you could call leveraging those reserves by buying other things with them in the hope that they're capable of returning the principal at the time when the principal is due and needs to be paid out. I mean, it is a do-si-do, and do-si-dos don't do well during downturns. Even the government, who's the Federal Reserve, let's be clear, the Federal Reserve, which is controlling this increase and decrease in the rate, is exposing the governmental bodies to some of the same risk. I'm just saying.
So, you put your finger right into the eyeball of something that I think is reasonably likely, which is as follows.
Okay.
There are three major credit reporting agencies. Moody's. These are weird names, by the way, but that's what Wall Street has
Okay,
put together.
we're in the equities world, and let's stay in the equities world for a minute. We'll go back to real estate in a minute, probably a couple minutes.
And believe you me, it is all interrelated. Anyway, the three main credit reporting agencies are Moody's, Standard and Poor's, and Fitch. And you may recall back in, I believe it was April of 2011, 4 days after Congress raised the debt ceiling, Standard and Poor's came out and said, "Okay, gang, you know what? Our responsibility is to objectively rate the valuation of U.S. government debt, and we're lowering our credit quality of U.S. government debt from triple A, which is the highest, down to double A plus." And that was a whole big thing in the bond market, where if the credit quality goes down, think about it, the valuation is going to go down and the yields go higher. Coming back to your question, and this is
therefore the cost of holding those goes up, which means the cost of the government having to maintain that, in theory, can go up, right? The asset value goes down.
Bingo. So we now have more debt than ever, and if we have a recession, GDP, which is where Treasury pulls its tax revenue, GDP is going to go down. All through the last decade, going back to 2013, we had a buffer or a margin between GDP being higher than the cost to pay than our taxes. So the GDP was putting out more than required, but now we've inverted. Our taxation is 25% higher than GDP, which means, okay, that's a bad thing. You assimilate it to a college student or a recently graduated college student whose income threshold could carry, I don't know, $5,000 or $10,000 of credit card debt. But once that credit card debt goes to 12 or 15%, then things start to break. So my point is as follows: if we have a credit quality downgrade, if we have a recession, if those two things happen synchronously, then the valuation of the bonds go down, the yield curve steps higher because the valuations have come down. Then we've got ourselves into a real pickle. And if we go back to the Great Recession from 1939 to from 29 to 33, you can easily you can Google this, but I think we had 18 billion deficit spending, and that jumped to 31 billion deficit spending. And so to get us out of that bad period of time from the Depression, we had a world war, tragic as that is, that caused our economy to get going again. And we had massive government spending. We can't afford massive government spending right now. That's my point. And so could there be a credit quality downgrade? Yes. And that will automatically make the yield curve go even higher, which would be hugely problematic.
Okay, so rather than having everybody freak out about this, let me ask this next question, which is, that is true, and we exist in an international market. So what has saved us in the past is that even when our credit rating went down, was that we were still what one might call the cleanest shirt in the laundry. So even though you would expect the demand for our bonds to go down, the price of our bonds, the value of the bonds to go down, therefore forcing the yield to go up, because that would be the natural response when you downgrade the risk on a bond, right? What we discovered was we were still the cleanest shirt in the laundry. So we still had China and a lot of other larger economies, China and Japan being the next two largest economies to our GDP, continuing to purchase inside of purchasing our treasuries as a
Yep.
safe haven.
Yep.
So the question isn't just, does that change? Does our grading changes? Does the perception of us as a safe haven change in comparison to a larger international market?
Yeah. Again, you put your finger right on the
I'm just asking questions. You're the one
bullseye.
who has to answer them.
No, well, I think it would change the perception. And it depends on, some pension funds buy trust documents. So a pension fund or your company 401k plan, these things are all governed by a trust document, and sometimes there's crystal clear mandate as to the percentage of allocation to AAA assets versus the entirety of investment grade, which is AAA,
Double.
double A, single A, triple B. So that's investment grade. So some trust documents will say you can do whatever you want. You just got to have 15% in the investment grade category. Or others will micromanage it and say you've got to have 4% in triple A only. And the only two companies that are triple A, the only two entities that are right now triple A rated are Microsoft and Johnson and Johnson. Every other corporation is something less. Anyway, if you fall out of that upper trust as far as credit quality, the ripple effect, could be hugely significant. And then our borrowing costs go up, and that pushes us further out of that 110, 125% debt to GDP ratio. And so, the implications of a significant recession and a credit quality downgrade would be really problematic, which kind of goes back to understand your risk before you can evaluate risk and before you can put risk to work. I'm using your words now. Understand your risk so that you can then evaluate risk and then put risk to work. But you got to understand it first.
You understand it first. So many juicy topics, Ted. This is the problem of talking to you. So many juicy topics.
No, sorry.
For time's sake, I'm going to leave that topic where it is. We can totally move into understanding risk, the last topic you talked about, right? So you and I both, we talked about in our previous conversation that you and I both have seen some pretty significant upturns and downturns, and that it takes a more mature investor ends up with a different point of view. The younger investor might be focused on, well, what can I gain? But the more mature investor is more focused on, what can I lose? So I know you went through you were a trader, I believe, or in an equities position in 2009. So tell me more.
Yeah. So
Sorry, in the .com, not 2009.com. Go ahead.
Yeah. So my first job out of college that I turned into a 24-year career. I was a portfolio manager at Merrill Lynch in the PIA program, which is a little bit different than just an investment advisor. As much merit as there is to being an investment advisor. So PIA, personal investment advisor, is a discretionary role, regardless. In the late 90s, I had a grizzly old investor. This is pre-bubble of .com, and he wanted to buy 2,000 shares of Cisco, and at the time Cisco was probably $125. And there, as you mentioned, there's kind of two frames of mind when investing. There's investing to make as much as you can.
Mm-hmm.
There's also investing to get what you need, and generally the folks that have less hair or gray hair are those that invest to get what you need, and those that haven't been bruised and scraped and battered by risk, it may have a different, or the invest to make as much as you can type of mentality. Anyway, this investor asked me, when considering 2,000 shares of Cisco, he said, "Ted, how bad could I get hurt?"
Right.
And I'll never forget that, from the perspective of everybody else wants to see how much they can make. Everybody else wants to lever up as heavy as they can, because from 2008 to 2021,
Mm-hmm.
it gets in our head that that's normal. And it was so not normal for the Fed to move from, I think, 15 trillion of debt to 31.4 trillion of debt now in May of 2023. Uh, so, so the notion of, okay, how badly can I get hurt with this trade was what this investor was talking about. And I think um, that the mindset needs to be understand, evaluate risk, and put work to risk. From the evaluation perspective, an investor who's looking at the world of placing capital in commercial real estate or in the stock market, when thinking about how bad can it be, is there a preferred return on the stock market? And the answer is clearly no. You just get what you're going to get. You might have 1 or 2% cash on cash coming from that stock by way of a dividend, but you're also going to have, subject to market valuation. So right now we're at a PE ratio forward earnings of 19 times, and that is that is much more on the higher end than on the mean average or statistical. Where do we generally trade on forward earnings? We're 30-40% above
I was going to say, give
above
us the PE ratio where we generally trade, because you talked about that last time, right? Like, why is the
yeah,
stock market so vulnerable?
so
18% versus.
So in 1982, and I would encourage viewers to pause the recording and Google this, but in 1982, the PE ratio on the Dow Jones was less than 7 times earnings. So if a company earns $1, the PE ratio is, if you knew the PE ratio and you knew that it earns $1, you can multiply the ratio by the dollar, and you would know that the market would be trading at a value of 7.
Mhm,
Well, if you're trading at a value of 19 times earnings,
mhm,
whatever the earnings is, doesn't really matter.
mhm.
If 19 times earning is on the higher end, and if we're headed into a recession, which means earnings will slow, generally speaking, when things get rough in the economy, people are not of the perspective, hooray, I'd like to take on way more risk. I'm going to go on margin, or I'm going to go buy on a buying spree. That's not what they do. People think, okay, let's retrench, let's gather some data, let's see where this thing settles out. And I could easily see the stock market trading at $3,000. I'm sorry, the S&P 500 could trade at 3,000 in the next year. Now, is that investment advice?
Yeah.
No, because just as much as it's right now at 4,200 or 4,150, whatever it is, it might go to 5. So my bias would be we're headed into a recession. There's likely to be an earnings contraction in corporate America, and that is likely going to be happening in commercial real estate as well. So be careful of the asset class that you're in, but there's also good reason to be optimistic, because as sponsors find assets that benefit from transition in the economy, those assets that throw off cash durably and consistently, the multiple, the cap rate is going to, from my perspective, get compressed even lower, because the valuations are going to go higher because the cash flow is coming off more and more and more. And so if you find pockets of commercial real estate where tenancy moves higher as the economy transitions, then you're on to something.
Okay,
So it's
well,
just,
I'll finally fine. We'll move on to real estate.
okay,
I have one more
okay,
economics, economics question I'm
sure,
going to ask you, but we're going to move on to real estate. I'll come back to that one. Okay,
okay,
so when we're talking about equities versus real estate, right? So I've been all hot on my theory. I have a theory. I'll confess my theory. My theory is that we're looking at a similar situation. The Fed is looking at a similar situation as what we saw from 1977 to 1982, where they started increasing rates in 1977, and the final effect of that, as the lowest point in the equities market was in 1982, and the lowest point in the real estate market was in 1982. So we saw a 5-year movement. It took 5 years to unravel. I think the Fed is looking at a similar situation, because stagflation, as we know, was the primary force at that time, right? So they're trying to control hyperinflation, which was effectively a stagflationary cycle. I have a theory, and I want you to qualify whether you believe in my theory or not. But that being said, what I want to talk about is, why did real estate go down so less severely in that 80s time period It went from 70,000. National price of single family homes went from 70,000 to 66,000. The S&P lost over almost 45% to 50% of its value in that time period, right? So when you do the percentages, you're like, yes, real estate is not hit nearly as hard in that time as what was happening in equities. Now, why do we think real estate's going to continue to do very well in comparison? So it's going to do worse. It's going to be a downturn. It's going to breathe out. If you own real estate, let's not be confused, right? You're going to see a downturn in your real estate holdings. That is true. But in comparison to another investment possibility, which is known as the equities and bonds market, why do we love real estate? And why do you love real estate coming from the equity side?
Yeah. So my perspective is that is that it's we're not doing the investors. I'll say it this way: we would be doing a disservice to categorize all types of real estate as real estate. So, in other words,
Okay.
office is going to struggle.
Yes.
Yeah.
Let's break it down. I love it.
Yeah. At least for the next 2 to 3 years, from the perspective that Tennessee is down, borrowing costs are up, and so some of those borrowers just need to go through a receivership, which is a bankruptcy type of filing, because no bank will refinance that. Now, quick rabbit trail: Blackstone is looking to partner with some of the regional banks, and on the small and middle type of loans, 90% of those loans are owned by the regional banks, and so there's really there's some juicy business that could be done there. Regardless, so all real estate does not behave the same. If you can find the asset types that benefit from turmoil in the economy, and if that equity investment comes with a preferred return, the investor is really sitting pretty. And let's just walk through that real quickly again. So not all types of real estate struggle when the economy slows. Some types of commercial real estate do better by way of occupancy when there's turmoil in the economy. So if that asset class is given exposure on behalf of an investor's net worth, and if there's a preferred return, for example, a 7% or an 8% preferred return, that's an obligation by the entity to make sure that the investor, Christina, either by way of current cash flow or a liquidity event that may happen in 4 or 5 years to go round trip, the pref is the obligation to ensure that Christina gets at least 8% before the sponsor, maybe that's Spartan, maybe that's anybody, but before the sponsor gets to participate in the upside potential, Christina gets 8% per year. Now that could come from cash flow, that could come from the future value of a capital gain. And there's two big fancy $20 words to pay attention to: internal rate of return and equity multiple. Internal rate of return, just quickly, that's the present value of cash flow and the present value of a future liquidity event compressed to annualize your return. So a 15 to 20% IRR, that's typically what you're going to see. And an equity multiple is, if it's 1.8, that means you've had a 80% rate of return. And the number of years, it's important to quantify that. If it's over 10 years, that's less attractive than an 80% return in 5 years. So IRR, equity multiple, those embody a preferred return, and there is no preferred return in the stock market.
No.
And like you mentioned, from 1968 to 1982, that was 14 years. The market, there were 2 points in time there from 68 to 82. The markets were priced exactly the same. Now in 82, that was the low point before a major rally started, but there it is.
They call it the decade of zero return. I saw it once put out that way. I think what's important is the position of the return that the investor gets in real estate. All right, let's break it down for a minute. So we have the equity owners in a stock company, and then we have the preferred stock. Right? We have equity owners, we have loans, we have the preferred stock, and then we have the common shares. So this is the way it gets paid out. Employees get paid first, right? Then the next payment out is the loans, right? They come sometimes share positions, but the next payment out is the loans, right? The next payment out would be the preferred, and the final payment out would be the dividend to the common stock. But when you're an investor in real estate, there is the company structure, right? So there's the employees of the company, and then there's the loan. And on that loan is the big loan, which goes to the larger bank. But that next loan right there is the preferred return that's promised to the equity holders that are the investors. So you're not talking about preferred, you're not talking about common, you're not waiting to be the last in the chain. You're actually higher up in the chain.
Yeah. Yeah.
Sorry.
Yeah. Yeah. No, I'm smelling what you're
I
cooking. You did a good
didn't
job
want to
with
take your
that.
steam away from you, but I think it's
No.
important that people understand, like, when we're saying it's a preferred return, not only are you promised a return, if the return is there, right? You can't give something that isn't there, but you're promised the return and you're promised it higher in the chain, right? So you're actually in a better, safer, when we're talking about risk management, a safer position in the chain of payouts, right?
Yep.
So that's part of it. And you're even ahead of the final, many times, you're ahead of the final return that the company sees, whether that's
Hmm.
Spartan Investors or some other sponsor. You're actually ahead of their percentage return, and that your preferred is before the split, right? So therefore, right now, let's also talk about the fact that real estate is there's just control. Let's just talk about control for a minute. Not that I'm a control freak or anything, but yeah, I am. But that's besides the point. Let's just talk about control. Now, I own stocks and bonds. I've owned stocks since I was 9. I've owned real estate since
Oh,
I was
interesting.
17. Okay. So I've had a
Okay.
little bit of time to observe this dynamic. I obviously wasn't paying much attention in 17 to about 26. I was busy, completely distracted with other funner things in life, one could say.
Yeah.
But actually, I loved my 40s, truth be told. The 40s were my highlight. Okay. Way too much personal information for a podcast, but there you go.
No. Yeah.
The point is, is that what I have noticed is that real estate allows me more control. I don't have control over Coca-Cola. I'm not Warren Buffett. I can't buy into Coca-Cola and get Coca-Cola to give me some version of controlling shares or controlling interest in the company, or at least even the right to have a vote that decides the future of the organization. But when I owned my 30 unit in Knoxville, Tennessee, I and my partners, we all got to decide what were we going to do with this, from the heaters that were failing all the way to the grade of tenant that we were going to put in there, all the way to, do we even want to own in this area anymore? Like, the control is so much more direct. And that's true when you're talking to your sponsor. The sponsor has that same level of control inside of a larger moving economy.
That, that's exactly right. And the investor can determine by way of the choice of the sponsor, is it industrial? Is it multifamily? Is it retail? Is it, what have you? And what pockets of the country by way of geography are we going to be exposed to? So is it Detroit or is it Florida where there's, I think Marion County it's growing at 8 times the national average. And I was recently in Florida visiting the villages,
Okay.
and it's 20 miles long. It's a population of my age, 55 and above,
Well, yes, us
people
old
who.
timers.
Right. Yeah. Yeah. But as yeah, and we jokingly make fun of that, or maybe we're celebrating that, or I'm not sure how to quite phrase that. But the point being, you can choose the pocket of the country where you have exposure, and in so doing, control your risk,
Mhm.
which is good.
Mhm. And I think you count on the sponsors to be able to do that.
Yes.
Spartan, let's talk about Spartan in particular. So we were talking earlier about different segments in the market, what will do well, we think, in this downturn. Real estate is a very big subject. It's a little like saying, hey, every sector in the real estate, in this equities market, is going to do well. It's like, no, tech is different from the financial sector, right? Those are two
Yeah.
different sectors with two different responses to a larger event called a shift in the economics, and the Federal Reserve and what they're doing. Same in real estate, right? We have our sectors, if you want to call it that. I agree with you. I think office is already hurting. And I think office is only going to hurt more in this increased interest rate environment. And I don't have high hopes for office on the other side. Just saying, I think that office is permanently changed due to COVID and right. Not to stay too much on office, because really what I want to push towards is, what are the things that do well? What are the counter cyclical investments that do well in real estate when we're looking at a recession or a downturn?
So my perspective and our research directs us to self-storage as an asset class that does well either in good times or in bad. Now, it can do less well in good times simply by way of you look for a loan in multifamily and you can lever that, the purchase of a $10 million or a $20 million property, you can lever that at 80% debt and 20% equity. In self-storage, we're typically 65% equity or 60% equity, 35% levered or 40% levered. And it's just the way those loans work.
Mm-hmm.
But if you look at storage, traditionally, when life events happen, unfortunately, that could look like a layoff from a job. Um, all the implications of a business downsizing or moving or taking 20,000 of retail feet down to 8,000 of retail and putting inventory in a storage unit, which about 40% of our tenants are business owners. Anyway, life events happen, and tenancy has a tendency to spike in self-storage. So so there's an asset class where an investor, without being salesy and trying to be transparent, an investor really could say to themselves, okay, well, if there's six asset class, I held up the number, four fingers, and I said six. There's six.
If you have six asset four. I was okay. It's okay. We'll go with six though.
But whatever the asset allocation is, an investor can legitimately say to themselves, okay, if I have commercial real estate exposure, what is the asset class that I can prove to myself performs the worst and performs the best in a downturn? Going back to my investor in the late 90s, wondering how badly can I get hurt? So, and we owe this to ourselves. How badly can I get hurt if I'm in the business of making investment decisions in commercial real estate? So you have to answer that question. You have to write down, I think, write down what your percentage allocation is going to be to that asset class, and then maybe take 2 or 4 years to scale into that exposure. And you ought to have 4 or 6 different types of assets that you're exposed to. And so the stock market might be one of those 4 or 6 asset classes. So however the investor approaches it from a best practice perspective, you really need to write down, why do I think this asset class is going to be the better performing compared to all the rest that are available to me? And someone in your situation, Christine, is you've got the knowledge and the experience to walk through those conversations and help investors put that list together.
Yes. I don't want to be egotistical, but yes, I have spent 35 plus years developing the personal knowledge and experience as to what it means to walk through different sectors in real estate and investing. I'm not a stock expert. I'm not an equities gal, just to be very clear. I'm really a real estate gal, but I have spent a lot of time in contemplation in office versus industrial versus retail versus multifamily versus single family. I think they all, and storage in particular. And I honestly, my theory is in this, and I want to have you cross check my theory, because again, I honor the depth of your experience in the equities market coming to the real estate world. I'm like, to me, that is just such an unusual gift to be able to go from the equities world. I know there are others in the market as well, but to go from the equities world into the real estate world and be able to release some of the programming that the equities world has. Now, when I was 17 years old, I was getting my first real estate deal. My stock person that I did have a relationship with, the stock guy, he was very clear. He was like, Christina, never consider real estate an investment. It is a bad thing to invest in because because it's a depreciable asset, and the only thing you want to own in real estate is your primary residence. So I obviously clearly do not believe in Tom's statement at the time. I clearly didn't believe in it. My mom gave me a house at 17, and I have doubled down in my real estate holdings over my stock holdings almost every time. The reason being control, and that so many of the aspects can be similar between the equities and the real estate, but I have higher payout, more control over it. I feel like I understand it as a box better. People always need a place. I know, stupid. People always need a place to live. How many times have we heard that, Ted? I mean, come on. We hear that all the time, right? It's such a
Yeah,
cliche.
yeah, yeah. I wonder where Tom is today. I mean, that's people can smell it when a statement is self-serving
I
and
didn't
not
I
well-intentioned.
didn't smell that at 17 because I didn't know. I just
Sure.
didn't know at 17. But I decided that I didn't believe him. I just kind of walked
Yeah,
out of the office at that time and I went, you know what? I just can't believe that wholesale comment because it was just too extreme of a comment,
yeah,
right? I'm like,
yeah,
there is a lot of wealth in real estate. I know there is, and there's a horizon there for me. And
yeah,
so, okay, so therefore I didn't believe in Tom. But the point is, I feel like it's a gift to come from the equity side, to see the limitations of the equity side, to see the value of the real estate side is a gift because it allows you to be more of what I call an investor versus a equities or real estate investor. It allows you to raise your horizon line to be able to decide that I'm dealing with multiple different choices of assets. Can be stocks, can be bonds, can be real estate, can be gold, right? Can be, some people believe in the cryptocurrencies. I don't happen to, but that's me, right? It can be any one of these assets, investment classes, and it opens up your portfolio to a much larger level of allotment or uh, what's the word, Ted, when you differentiate?
yeah. Yeah, I think the asset allocation of an investor should be emblematic or should represent their preference or aversion for risk. I really believe that.
Completely. Completely. It should absolutely represent their preference or aversion for risk.
Yep,
And again, the way you approach assets in real estate, you can choose based on asset class, but I also am a great believer of choosing based on process. What is
yep,
that sponsor, or what are you going to do with that thing? Right?
yeah,
So I might love single family, but I don't love it in LA because I love the process of cash flow. So I like my single family in Indianapolis because if I was flipping, then I would love single family in Los Angeles. But if I'm looking for positive rentals, I don't. So when I talk about allocation and diversification inside of my portfolio, really I am focused both on the asset class, but also on what is the process that I am involved with. I might own two different things that are both multifamilies for two different reasons, and therefore have two completely different uh, risk allocations to them, right?
yeah.
Risk and reward returns.
It's really interesting. You're the second person to mention Indianapolis in the last week.
Yeah.
So I don't know what's happening in Indianapolis from a single family resident perspective, but clearly there's something afoot there because that's not just happenstance.
So let's double back to Spartan for a minute because we're running out of time, and I really want to highlight part of the reason why I have you on the show is personally, I love that you've gone from the equity side, realize the limitations and values of that into the real estate side, realize the limitations and values of that because they all have their limitations and values.
Mm.
Spartan in particular, I feel like is up to a very good move. So why don't you tell me a little bit more? You guys specialize in storage, but you guys also have, I believe, a newer fund. You guys have some newer
S- y-
movements going on that I don't want to. I want you to talk about, not me talk about.
Thank you for the opportunity. Shameless
That's
sales
right.
pitch.
Shameless. I'm laying up this shameless sales pitch. I asked you, so therefore it's not a sales pitch because I asked, right?
No. So Spartan has, just by way of perspective, Spartan has about 650 million of assets in the self-storage space. I'm sorry, 650 million and 67 properties. I'm not sure what I just said, but we have 67 properties, 650 million. We're primarily in Texas and then the Sun Belt, so southeast quadrant of the country. A few properties in Colorado and in the Pacific Northwest as well. But um, from a from an approach to investing in the space, we have a growth fund that is a land purchase fund as well as a troubled asset an entity in the growth fund. So we could buy either raw land or we could buy a troubled asset. There's no cash flow that comes from that, but that's a 2.5 equity multiple target in 5 years. Our income fund is much more the low risk profile investment, cash on cash, starting 4.5% in year one, walking higher by 1% yearly, and target internal rate of return of 15 to 20% over those 5 years. Um, and then we also have a debt fund. So we'll pay an investor 9% for borrowed funds, and the debt fund borrows funds from investors to loan to the growth fund for a land acquisition for entitlement purposes, or maybe we'll flip the property at certificate of occupancy in the growth fund. Um, Suffice it to say that if an investor is looking for exposure to self-storage, there's a debt opportunity and there's two equity opportunities. One is high risk, one is low risk, but there's a tool there that could be used on behalf of the investor. And again, I would frame all of this, and this is now not salesy. I would frame all of these decisions by way of what is the investor's preference or aversion to risk. The age old adage of your age with a percent sign behind it. It used to be that's the percentage of your net worth that you should have in bonds. Well, when the stock market has been so sweet the last up until recently, you know, investors have been lulled into I think, a false sense of confidence that it's okay to have an exorbitantly high exposure to the stock market. But when that breath out comes, and we may have a prolonged um, drawdown in the stock market, and that's a may. I didn't say we will. We may. So if an investor needs that income for retirement, or just to lower the anxiety level, which we all have some level of, you can manufacture that income by way of syndicated exposure to real estate, and then from there the investor should connect with you and have a conversation about, okay, what's my highest probability of success.
Yeah, and I agree with as you know, I'm a young registered investment advisor. Young in comparison, even though you and I are almost exactly the same age, I'm young in comparison of taking that mantle on. I come at it because I come at it from real estate, moving across as an investor, right? So I come at it that I don't believe in the amount of bonds you should hold, take your age, add the percent at the end of it, right? So 54% in bonds is what I should be holding. But I've seen from personal experience that bonds is not the safe haven that people constantly believe that it is, right?
And so the exposure can come by way of a syndication to some type of commercial real estate, and that's a bond surrogate from my perspective.
You just took the words out of my mouth.
Yep.
Exactly. When you really perceive yourself as an investor across multiple classes and not in a particular subsegment, real estate versus equities and bonds, then you have greater choices for what are safe harbors to be invested in.
Yep.
Having lost money in the .com, having lost money in the 2009 downturn in real estate, it has led me with the battle scars of being able to say, since neither one is a safe haven unto itself, I need to go higher. I need to go higher in my perspective and higher in my commitment as an investor to be able to understand. So I have one last theory. Remember, I mentioned in the middle, and I'm going to ask you directly. I personally believe that we're going to see the Fed do a similar cycle as what we saw them do 1977 to 1982. I think we're going to see them increase interest rates. I think we're going to see them slow down or pause, take an assessment on the market, and then increase interest rates again, because I think that's where they are now. I think they've done a series of aggressive increases. They're slowing down. They're only doing 25% increases, right? Or 0.25% increases, which is a slowing down. I think they're going to take time to assess. And I think their assessment is going to be that they need to return to increasing interest rates, looking very much like when they were trying to control the stagflation in the early 80s. Am I full of SHIT, or do you think there's any value to this theory? You can totally call me out. It's totally good. I'll still post it, I promise. You can tell me I'm totally full of it.
I think the risk is to the downside, that the Fed has gone too far already.
Okay.
There are 10 components of the conference. So there's a nonprofit board called the Conference Board, and there's 10 metrics that they have that are leading economic indicators, and that's the resource that the Federal Reserve draws on. And of course, the Fed draws on a lot of resources, but they do listen to the Conference Board. So 8 in the 10 metrics are showing recessionary behavior at this point. I think that I think that this week, this is the first week in May, I think we'll have 1/4 of 1% increase by the Fed. I think that's going to be it. If I had to guess, I would say May of 2024, the federal funds rate will be somewhere from 2% to 3.5%, because of a recession, in the Fed trying to recover damage that they've done
Right.
to the economy. So I might go the flip side of the coin
I
on that
love
one.
that. Thank you.
That's
I
what makes
love
a market.
that. That's fantastic. Because I'm not interested in my own bathwater. I'm really interested in
Yeah,
understanding what other economists, hobby economists. I'm a hobbyist at best because I don't have a master's in economy. I have a bachelor's in business, right?
yep,
So, but what are other hobby economists? What are they looking at? What are they tracking, and why are they tracking it? Because that's ultimately what informs our decisions and informs
yep.
what it is that we're going to be predicting. Because as investors, professional investors, being able to understand what is the environment we're playing in is the thing that is going to help us move through these breaths in and breaths out. Thank you so very much, Ted. This was wonderful. I love it. I
This is
love it.
fun.
I love it. I could do econ stuff with you all the time. So, how do people get a hold of Ted Greene over at Spartan Investments if they want to be able to invest with Spartan? Because you guys have thought through this and they have somebody as wise as you, Ted, on staff.
Well, thank you for the generous
You're
comments.
welcome.
I'm easily found on LinkedIn, Ted Greene. I have an E on the end of Greene. Spartan-investors.com is where you can find our company, or you can just email me at ted@spartan-investors.com.
Thank you so very much. This is Christina Suter at Real Estate Breakthrough. Hopefully, I've brought you another quality guest who's going to help you move through this upcoming recessionary times, because we're not officially in a recession. Thank you so very much. See you next week.